So now
Okay.
I'm net 50,000 on that, right? And I'm really happy
Beautiful.
because I made money, right? You know?
Yeah. It's so true, so true. I mean, this is so exciting. In not stocks, you can't do it because if you lose, you just take out $3,000 for that year, as I recall. But in
Yeah.
leverage, in real estate, we are able to leverage with the loan, good debt, we call it, right, with the bank. And the appreciation, the bank doesn't want any of the appreciation. They want their balance of the loan back. That's it. And GPs and LPs share the profits or the gains, capital gains, we call it, but then you're able to reduce that impact with the negative that you have gotten over the years and carry forward. Very nice. Thank you. Thank you so much. You
Yeah.
know,
Yeah.
what other like ways we could do it? I know when we give distributions in the quarterly distribution or monthly distributions, this is returns on capital. Is that right? And returns off capital is when we give the principal back. What's the best way? What's the best way? I was trying to
Well,
kind
I
of.
mean, I think the best way, if I'm a limited partner, I'm a passive investor, right? I
Mhm.
want returns of capital, returns
Yes,
on capital. I want returns on capital because that
on
means you're
capital.
making money, right?
Yeah,
I mean, a
exactly.
return on capital is cash flow from the
The,
profitable operations of the business,
yes,
right? And
totally.
that's what I want. I don't really, I want my money back at the end,
Yeah,
right? But I
yes,
want to have return on capital during the life of the syndication. I want to know that
yes.
the entity, the actual the hotel or the senior living or the whatever
Hmm.
is actually
Hmm.
producing. It's profitable. It's producing net income that's then shared across the capital stack, the the investors that invested in it. We all want
Yes.
our piece of the cash flow, right? And what's
Distribution.
nice,
Yeah.
yeah, the
Hmm.
distribution. And what's nice about that is I can actually put cash in my pocket every
Yep.
year,
Yep.
and I still have a small loss on my K1, which means I don't
Yes.
pay taxes on that cash. I got the cash. That's the whole idea of why you would want to be a passive investor is to get
Yes.
tax-free cash flow.
Yeah. I agree 1000%. So in their K1, because of this P&L on the property, it made all the profit for that year. And the investors got LPs, limited partners or partners, if we do the other way, they get that distribution of the dividend or cash flow. But the line item of accelerated depreciation, cost segregation, or regular depreciation minus it's a paper loss. It's totally a paper
Right.
loss, which makes
Yeah.
the whole P&L go negative at the bottom for taxation. Huh?
Yeah, exactly, and that's the real benefit. It's really a cool concept if you think about it, and that's why passive investors should be investing in syndicated deals is for the tax-free cash flow. The
Yeah.
and because it's a great deal. Like if I'm investing with you, it's because I think you're going to operate it profitably, and then you're
Yes.
going to sell it for a profit, and I'm going to make money, right? The
Yeah,
actual even if
exactly.
I can use the tax benefit is really like the cherry on the top of the
Yeah.
ice cream sundae,
Yeah.
and it's the cash flow that the tax-free cash flow that I'm really looking for.
I love it. Love it. Now, for the retirement funds, right, Ted, they are already got that inherently built in it self directed IRAs, 401ks, all these plans, SDIR, right? We call it self directed.